Thank you, everyone, for coming. Really appreciate it. It's a great crowd tonight. Thank you. And this is our team. So Michelle Blood, Ginger Belker, and David Weil. We really appreciate being here at the university. Larry Guyanchetta, Dr. Guyanchetta, the Dean of the Business School, is here tonight, which is a real privilege, and we appreciate you coming, Larry. Thanks. And we really appreciate being the fact I have an alumni here. Being in this room is really kind of special, so thank you. As you read. So we sent an email out last year about a change that we made in the business, and so we purchased Delano Investment Advisors, and we were approached early in 2013 by Marshall Delano. I don't know if anybody knew Marshall, but he was having some health problems and had an advisory business that he was interested in finding a buyer for. And so normally we would not be interested in another advisor's business in town, being that what we do is fairly different than most, except Marshall was a special guy. And similar actually to a relationship that I had with Phil Fisher early in my career. Marshall actually had a relationship with the legendary Ben Graham early in his career, and developed a portfolio management business around the value Ben Graham style, which is very unique for here in Missoula. So it did pique our interest. And then at the same time, simultaneously, you know, our research analyst, David Weil, David was progressing at really a breakneck pace in his research and his work, and he was gobbling up annual reports and 10Ks like they were potato chips. And a stream of ideas was coming out of David that was almost insatiable. And it was evident to me that we were kind of holding David's progress back because our turnover in the FrontStreet portfolios is fairly minimal. So the idea came that we maybe could purchase Marshall's business, and it would be an outlet for David to expand his career. And so and David was obviously ready to start to manage his own portfolios. And the other key item was that, and everybody has their own tendency as to where they head in this business, and I always veered towards the Fisher style, which is for the qualitative side of the business, and sometimes willing to pay a little more than, certainly a lot more than Ben Graham would have ever been willing to pay. And we have a tremendous amount of respect for both the Graham model and the Fisher model. And David was naturally starting to lean towards the Graham model. And so the fit was actually almost perfect. And so we actually completed the deal at the end of 2013. And quite sadly and tragically, Marshall passed away 2 weeks later. So David was in a position to try to connect with these clients without the assistance of Marshall, which was a real challenge, and he's done really a phenomenal job at it. And the structure that we put together is the first 2 years, all the profits for the first 2 years go to Annette Delano, and then 25% of the profits thereafter go to her. is kind of the way the deal is structured. And so, you're more than willing to ask David during the meeting about his process, about anything you want about the Delano side of the business. We've got some of his cards up there if you're interested. Or you can chat with him at the break or after the meeting also. And his address is in the building over by the mall, the 1821 building. And Delano is off and running. Four.
You're a good counter. You better be.
So this is our criteria slide, as you have all seen, I'm sure, hopefully. And so, David's efforts at Delano have really been primarily spent, obviously, on portfolio management and on client retention and relationships. And so the back office stuff and the compliance work really has been handled and covered by Michelle and Ginger. And again, we have not missed it. They have taken on this quite substantial additional workload, and FrontStreet hasn't missed a beat, and it's pretty awesome. So our criteria slide, the keys, are teamwork and employee empowerment. And the idea that we believe on teamwork is, and it's the principles of Deming, is that you need to drive internal competition out of the organization. You want to cooperate and not compete inside the organization. And I can tell you, our company is a cooperative machine at this point in time. We are so efficient, it's just a delight to come to work every day. And it's really very satisfying, to see these things actually operate in real time with the companies we own. I can tell you it's 10 times more satisfying watching it occur in real time every day when I come to work. And so Michelle and Ginger are remarkable people. And literally there's not a shred of internal competition, and we're all empowered to do our jobs specifically, and then we all pull in the same direction at the same time. So it's what it's supposed to be. And it's a delight to come to work every day, and I really feel like every day is the beginning of a pretty exciting journey, both for you all and for our company. I guess. So we'll look at the performance for last year and year-to-date this year. So last year, the S&P 500 was up 32.39%, quite robust. The Aegis Value Fund was up 34.87. The Fair Home Fund was up 35.17. Longleaf was up 31.75. The legendary Sequoia was up 34.21, and Tarkio was up 38.50. Our fund is Tarkio, by the way. A little different story. This year has been pretty choppy between, so far year to date. The S&P is actually up almost 5%. Aegis is actually down 3.5%. Fair Home is up 7%. Longleaf is up 4.64. The legendary Sequoia folks are up 1, and our account is basically dead even as we speak. for the year. And it's been a year of, in a narrow range, but very violently moving up and down between that range. And these numbers, you'll see will change 1 or 2% within a few days, actually, compared to each other. I'll go 6. Just as an example, I just want to show you, last year when we met, the S&P was actually up 1061 for the first quarter of 2013. Tarkia was up only 595, but we ended the year up 38.5. So, these numbers, the short-term numbers can change rather dramatically fairly quickly. And we're gonna march right into Q&A. I hope everybody brought their toughest questions. And so, Ginger, you want to go to number 7? This is what the Tarkio portfolio looks like as we speak. These are the percentages of each company. You also have one of those sheets at your desk. And also, along with those sheets, there's a handout up front of Mr. Market, which we've talked about at some length every year. There also is an excerpt from this last year's Berkshire Hathaway annual report. Our opinion, it's the best piece ever written on the stock market, period. And we highly encourage you to pick one up on the way out. I have really a hard time remembering to repeat the questions. So if everybody kind of would remind me, maybe I won't forget. And with that, let's open it up for Q&A. Yeah, Russ?
We just got a letter in the mail today or yesterday about Claro, a class action suit. Are you aware of anything?
Yeah, anytime a stock goes down in value, there's a class action suit that ensues. Normally, actually, Michelle, it's $3 per...
No, 4 cents or 10 cents a share.
3 cents a share?
10.
10 cents a share.
Yeah.
So if you times that by the number of shares you got, it'll get you some idea whether it's worth it for you to send the thing back. But if you do, just sign it, send it to us, and we'll fill in the blanks.
Okay.
Sorry, Michelle. I didn't
It's based on the number of shares you own that you bought during the period.
Yeah, it's a very short period.
It's like May to like September or something like that.
Yeah, it's not just what you own, but it's what was bought during this very small window.
What happened with
So
What company was that you're talking about?
that is O'Claro. And so why don't we've sort of done it. I think what I'll do is I'll just give you the whole telecom story again, and then show you where O'Claro fits in. Because it's a bigger story, it's more of a broader theme than just the O'Claro theme. So, kind of every year we've gone over the telecom piece. There is one major difference this year than past years. But the general idea is that back in 1997 to 2000, there was an overly aggressive amount of money that was available to build out the telecommunications infrastructure in the form of a fiber optic network or fiber optic technology. And like all Wall Street activities, they got over enthusiastic, and the structure was overbuilt, and there was more capacity than was going to be needed for a long period of time. But the flip side of that is that the internet has exploded pretty much the way the people had, on their wildest dreams, would expect that it might. And so the amount of traffic over the network was growing at 100% a year, nonstop, all the way, regardless of what the pricing was, because there was more capacity, but the traffic was growing at over 100% a year, right on through to almost where we're at right now. And if you compound anything at 100% a year, you know, something starts to happen. And so the fiber optic network, which was overbuilt, the pricing was tragic for the owners of the network. But what that enabled was all of this activity to occur. I mean, people for a long time thought that the internet was free. And the reason was because it was overcapacity, and the pricing was difficult for the owners of the networks. And so that's why the collapse of the telecom companies happened in 2001 and 2002. But our thesis was that as long as the traffic continued to grow at a large rate, whether it be 100% or something there close, then eventually this fiber optic network would be a very, very valuable piece of real estate. And it's a fixed cost business. The money was all raised up front in a bubble, in a frenzy, and that kind of money will never, ever be available again to build out the network. And the biggest expense was getting the right-of-ways and digging up the streets. It wasn't necessarily the equipment or the fiber cable itself. And so our investment thesis on this was to buy which we thought was the premier network on the planet, which was level 3. We accumulate, every year we've had this discussion, and every year level 3 was asked, the questions were asked as because it was the worst performing stock in our portfolio. And we just kept accumulating, and we accumulated it for probably over 6 years. This last quarter, actually the first quarter of 2014, the fixed cost business, the traffic finally got to the point where it turned largely, staggeringly profitable. And that is the beginning of this story, by the way, not the middle, or all suddenly this story gets really exciting. And because it's a fixed cost business, the profitability just gets better over time. And there's $40 billion of capital was put into their network over time, adding the companies that they have acquired over the years. And they bought them at nothing for nothing. I mean, they didn't have anything to spend because the industry was in such disarray. They managed to make probably, I don't know, 10 or 12 acquisitions to gain more fiber optic capacity when they really didn't have anything to spend. It's just that the assets were selling so cheap at the time. And so we're really pleased with what's happening with level 3 as we speak. The secondary investment that we've made in this area is with the equipment companies, the ones that make the fiber optic components that make the network run. And that's admittedly a much trickier business and very short-term bursts of cycles. It'll burst up, burst down, burst up, burst down. And we've had a fair amount of history, actually, going back probably almost 30 years with telecommunications equipment companies. I don't know if you remember ADC, and there was a few other companies that we've owned in this space before the fiber optic technology became so prevalent. And so we had one basic company that was exposed to this equipment space that we were accumulating, mostly during 08, 09, maybe 2010 a little bit, and that was O'Claro. The stock went 10 times from low to high, actually, during the last upturn. Unfortunately, we were not aggressive with selling the stock after the big move had occurred. And when the next down cycle came, O'Claro actually got in a little bit of financial strain, and the high to low on O'Claro was more dramatic than it would have been otherwise, which is the reason why the lawsuit, because of high-low on O'Claro, although we didn't buy anything at the high, we took a round trip basically on it. And the reason why we didn't sell O'Claro was not a very good reason. It's a pretty sour excuse, but when I was getting ready to start to lighten up on it, a very close friend of mine and one of my strong primary mentors actually started to buy the stock right when I was getting ready to exit it. And it was really hard to literally sell it to him. And when the downturns in this industry come, they come fairly rapidly. And so, we did in the Tarkio fund, we actually bought a fair amount of stock at very low prices, and have had, from low to high here, I've had the stock almost tripled. We got out of some in Tarkio and still have some. But during this last downturn, we've not bought any more O'Claro other than what was bought for Tarkio. But we have bought JDS Uniphase, we've bought Sienna, and we bought Finisar. And we're loaded for bear on the next cyclical upturn. And our belief is quite strong that as long as this traffic keeps growing at the pace that it is, that there'll continue to be cycles, and that there will be another upcycle. And particularly now that some of the companies like Level 3 are starting to really turn profitable, the next upcycle probably will be quite interesting.
Are those new purchases in that network area too? So the network, you said you had that one level and then
yeah. So the question was, are the new purchases in the network? So the new purchases, our play in the network is Level 3, and we do not own any other companies that own a fiber optic network. All the other companies are component companies that make the boxes, that make the bandwidth work properly. Yeah, Jim?
Who is Level 3's competition?
The question is, who is Level 3's competition? And primarily it has been AT&T and Verizon. The problem with AT&T and Verizon is that they also, this is called a fiber optic backbone, which is what everything connects into. And your wireless, your cell phones, everything eventually connects on to a fiber optic wire. It's literally hardwired. And then the last mile or the last connection with either your cell phone or your TV or whatever it may be, all comes in, there's all kinds of different people competing for that space, whether it be cable or your wireless cell phone, or it's a variety of different ways to connect in that what they call the last mile. And so the primary competitors, the companies that have had fiber optic backbones were AT&T and Verizon. The problem with those two companies is that, initially these were copper networks. And over time, they have transitioned them from copper to fiber. But they're an amalgamation of a bunch of stuff. And by definition, it's not very efficient. I mean, fiber is so much more efficient than copper. It's ridiculous. It's not even, it's a joke between the two. And so, level 3 started out with a clean sheet of paper. So by definition, their network is way more efficient than Verizon's or AT&T's. And now Verizon and AT&T, all their capital that they have to spend gets completely sucked up with the massive amount of infrastructure that they have to put in to their wireless businesses. And so they just aren't keeping up with their fiber optic backbone. So the only real competition that level 3 has are the other companies that started with a clean sheet of paper. And it's a limited number. And
Level 3, the largest of them?
yeah, and globally, they merged with Global Crossing. And so it is a massive global fiber optic network. And there are big advantages to scale in that business, because if you don't have scale, if you only have a piece, then you have to buy somebody else's network, you know, to go over a particular distance that you don't have access. And over time, it's going to become more of an advantage to have scale. It's an advantage now, but it's going to be more of an advantage over time.
Is the government using level 3?
Yes. The government is everybody uses this fiber optic backbone.
Some in other ways than others.
And our history actually in this area goes all the way back to 1988, when Phil Fisher introduced me to a company by the name of Raycam. They had a division called RayNet, and they were about 20 years ahead of their time. What RayNet had was a scheme to bring fiber optic technology all the way to people's homes, and all the exotic things that could potentially happen. It was like Star Trek at the time to me, listening to it all, and it actually all came to pass, which is pretty interesting. The problem is RayNet was 20 years ahead of their time, and actually the RayNet division forced Raycam to sell at, basically took the company down. They had to sell at prices that they probably preferred not to have sold at. And the founders and the people that are running Finisar, which we think is the strongest now of the component companies, they're ex-RayNet people.
So are most of the component carriers or companies level 3 vendors, or are they AT&T and Verizon vendors as well?
Question again?
The component carrier companies that we're investing in, are they level 3 suppliers, or are they level 3 Verizon and AT&T? Are they all three, or just
Yeah, the
one?
question is, are the component companies customers of level 3 primarily, or everybody? And there's a lot of people now building out fiber optic networks, and that's, like I said before, the industry is a little tricky. Actually, I'll be looking forward actually to taking some profits the next time around. It's a lot of work to keep up with this space. But what's happening is that a lot of the new build-outs now are in data centers, are with companies like IBM or private enterprise. and there's some shift in getting away from AT&T and Verizon, and a lot of the network is being built out by others. In particular, all these data centers that are being built, there's a real big surge right now going on because they're interconnecting inside these data centers with fiber optic technology, and now at higher and higher speeds, where they used to go at 1 gigabit to 4 gigabit, they're up to 40 and now 100 gigabits. And that jump to 100, actually, we're seem to be positioned right where we want to be with that leap. But again, the component companies are, I would categorize that we're renting them. We own the network though, and we're going to own that network. I mean, if there's anything that I could look out 20 or 30 years, and what is the demand going to be greater 5 years, 10 years, 20 years, 30 years from now? The most visible thing I could possibly see out that far would be that demand on that network is going to continue to grow at a meaningful pace for as long as the eye can see. Satellite doesn't have the bandwidth. Anything wireless, the comment was that, you know, satellite or over the air, and there's not much bandwidth. Basically, on the cell phone, what they're doing now more and more is that they are connecting the wireless device to the wired device as quickly as they possibly can, and they're shrinking that space because that distance in the air reduces tremendously the amount of information you could send over your device or receive. Right.
As I understood you earlier, David at this point in time has nothing to do with Tarkio.
Right now, he's absorbed totally in getting Delano up to speed. There'll be more collaboration once he gets, you know, beyond that point. Questions? All right, well, let's go to Dana's question. I keep being told by financial pundits that now that I'm retired, I should be diversifying my retirement funds. This is my retirement fund for the most part, so what is your general advice to us older guys who are lucky enough to be retired and still be alive? I'm not needing this money currently, so I have felt comfortable with leaving it where it is and letting your team continue to grow it. So, that's a really good question. And it's a constant question that we get, and I'm going to probably answer it maybe in 2 or 3 ways. And while I'm going, please interject other questions as we go. Take us to 16, please. So, we've talked about this before, but the industry gets pretty crazy. The financial services industry gets quite creative over time. And the idea of diversification and pie charts, and we think really and truly you can break this thing down that there's really only 3 basic asset classes. And for something to be an investment, we think that it has to be able to produce some cash. And if it doesn't produce cash, we don't think that one can know what to pay for it. If you don't know what to pay for it, then it's not an investment, it's a pure speculation. And we think there are only 3 broad asset classes that have this unique characteristic that create cash. And they are a business, obviously, and the stock market just basically is buying pieces of businesses. Real estate, and fixed income securities or bonds. And so our belief is that once in a while, one of these trices, how's that? Is that right, Larry?
I see you have to look at it.
Gets out of whack. That sort of a bubble gets created, that it gets dramatically overvalued. And so our belief is that it's important to understand when that occurs. And it occurs periodically. You know, the stock market got in such a condition in 2000, and the fallout actually didn't bottom out until 2009. The real estate market got out of whack in 2006, and the fallout from that was monumental, as we all know. And so we think actually that bonds or fixed income securities are in such an overvalued condition as we speak. And so generally what most people would sort of consider, as the question said, the pundits would suggest that at some point in time you have to put a certain percentage of your money in fixed income securities or bonds. We think buying something in an overvalued sort of bubble kind of situation is not a good idea, no matter what stage in life that you're in. And it's unfortunate that it happens to be when a lot of people are retiring that these interest rates are at this ridiculously low levels. But unfortunately, the markets don't know nor care what your position in life is. And so if we need to avoid this asset class, so you need to either avoid the class or keep very short maturities, and virtually they're paying nothing. That's the other option. And to be aggressive in this area, to try to get a little bit of yield, you're exposing yourself to a ridiculous amount of risk. And so, but what's interesting is the 3 are connected. And when one gets in a bubble, and you can see this over time, when one gets in a bubble, it draws money from the other 2. And when the bubble eventually breaks, it supports the other 2. And so the stock market bottomed in 2009. And the other thing that we also believe is, if something gets in a bubble condition, it really absorbs all the money available. And so it's almost impossible, in our opinion, for 2 of the trices to become in a bubble situation at the same time. So if you think one's in a bubble, then the other 2 should be safe. And the stock market bottomed in 2009, and we still think it's, we'll talk about that, in good condition. But the juicy one, in our opinion, is the real estate market, because it's probably only bottomed maybe 8 or 9, 10 months ago. And then you add to that very low interest rates, so you can leverage your real estate investment with extremely low interest rates, and it's what Charlie Munger would call a Lollapalooza, where all the moons are lined up. And it's pretty close to where the bottom was. And so, you know, a lot of people, conversations that I have, it's like, well, you just don't like bonds. Well, you know, I remember very distinctly with a good associate of a client, a good friend of mine that is very successful, and we had a conversation, and it was in 2005 or so, and his comment was, well, you just don't like real estate. No, I said, I just don't like it at these prices. And so we just don't like bonds at these prices. And so if you take that out of the equation, it is a conundrum for people. And that's what we're having to deal with. That said, the stock market is very, very liquid. It really is. It's a miracle that you could buy any company you want, any one of 30 or 40,000 companies worldwide, I don't know what the number would be, and you can buy a piece of any company you choose to buy for really a minimal amount of money to get in. That is incredible. And you can get out and have 3-day settlement and get your money back. That is really a cool thing. And I really appreciate it. The problem is most people use that liquidity to butcher themselves rather than to use it to their advantage. And so since everything is so liquid, and if you need money every month or every quarter, it's quite easy to sell small pieces of a portfolio and raise money. This liquidity can work to your benefit. The problem is most people use it, to work to their detriment. Because it's so liquid, they think they have to get in and out in a big way all the time. And it's very destructive. But you can use it to enhance your retirement. And we traditionally can, we'll talk about where the market has gone over long term and cycles, but from 96 to 2009, the S&P went nowhere. And during that period, we actually made some money in our accounts, maybe 4 or 5% if you average it out. And so those days we think are gone, and we're going to have a tailwind rather than a headwind for quite some time, we believe. And so we think if you took out 5% a year, that's a very doable number, and it gives you a large cushion going forward that you would actually build value over time. The only problem with the stock market is liquid. You can actually take a lot of the risk out if you know what you're doing, but it's not linear. And that's the only thing that I can't control. It is absolutely non-linear. And we accept that, and we appreciate it. It actually gives us advantage. And we can manage out money for people that need it every month out of equity portfolios. And we never missed a payment in 2008, 2009. And we fully recovered in 12 months. And last year we were up 36 or 37%. If you're taking out 5%, that's a cushion you could drive a truck through. The industry would, not probably agree with our approach to this. But, the industry didn't do a very good job of managing their money in 08 and 09 either, did they? I mean, Merrill, Morgan Stanley, these companies, Bear Stearns, Solomon, they manage their own capital right into the ground. You have to do what's rational, not what the question said pundits. The financial services industry says what is risk and what isn't risk.
If you're the only stock we hold in real estate would be St. Joe, is that right?
That is correct. Okay. Yeah, I mean
Is there any others that you look at?
We've thought about it. It's really not my area of expertise. There's just some circumstances that brought us to St. Joe that attracted us to it. A lot of packaged real estate products have a lot of, over time, have had a lot of chicanery in there. It's not an area where we've, where I would run to, actually. We've had some folks in here have had recent meetings with us. And if they're young and don't own a house, I beg them on the way out that they should at least consider it. I really think real estate is probably better bought directly than through some packaged product. We would not be even this year. We would be doing much better than that if we would have had more exposure to what I felt strongly would happen as the year progressed, but we didn't do it. And a lot of times it's, basically boils down to sticking with what your circle of competency is, and I didn't want to get too far afield. But there are some things about Joe that fit tight to what we know and believe, so.
Russ, that dovetails into my question. I'm seeing from the prospectus, since I'm new here, that you're a non-diversified fund. So, for example, my beef with sector ETF funds, is you get all the companies in that sector, and some are dogs and some are worth a look. And so I don't like those, but you seem to have a mix of stocks here, but you're not covering 10 or 12 sectors. You're just looking for value of the companies that you can ferret through, say, 3,000 to 4,000 stocks or more. I like your criteria for...
This is the criteria.
Yeah, I like the criteria.
And so our belief is that there aren't that many companies that operate this way. And so...
Right out of the chute, then, in other words.
Just over time, we've got one company we've owned since 1988, so we're very long-term investors. So this is the criteria, and we want our funds to be concentrated in the companies that fit tightest to this criteria, and to be able to wait for opportunities to buy them at reasonable prices. We actually do not wait for these types of companies to get priced at ridiculously low prices. We're willing to pay up a little bit, which is why our model is a little different from quote-unquote other value investors. We're more qualitative value than quantitative value. The Phil Fisher style of investing versus the Ben Graham style, which we believe strongly in both styles. It's just that I had this unusual happenstance of having a relationship with Phil Fisher, and it pushed us in that direction. Some of the best, and really all of our funds that we recommend, we showed the funds that we recommended earlier. And with the exception of the Aegis Value Fund, they're all concentrated portfolios. And Buffett said that diversification is protection against ignorance. If you're not ignorant, you don't need it. You need to have some diversification, but you go too far and you start to lose your ability to outperform. And if you can't outperform, you're better off in an index, which is what that article describes that you should pick up on the way out. Yeah, John.
What's been the trend for the size of the fund, and where do you see the management fees going?
The management fees? Yeah. So the question is, what's the trend in the size of the fund and the management fees? So the fund started at a dead zero, be 3 years of the 28th of June. And so it's been, let's see, I think on that sheet, we're at 21.7 or something there.
Yeah.
And it's the money, all the money that's flowed in so far has been controlled pretty much by us. that could change at some point in time. We actually get a Morningstar rating after 3 years. But so far, we've been able to control the inflows coming in. So they've been pretty consistent from 0 to this point over that time. And then we weren't sure if the fund would be an economical boondoggle or not. Particularly launching a fund like this in Missoula, Montana, where you really don't have the base in other areas that other funds that get launched. So we took the cautious approach and started at 1.25%. And then as the fund continued to grow, we continued to lower it, and we're at 1, and we're going to stop at 1. And break even is about 10 million.
Break even would be where your 1% covers your cost.
Expenses, yeah. Other questions? Why don't we take a 5-minute break? And you guys want to think about some more questions? If not, there's a few things I'd like to go over. Hey, Jerry.
You want to talk about Whole Foods?
Yeah, I would like to talk about Whole Foods. So, you know, we talked before, the market's generally flat this year. But it's been really anything but flat. I mean, the market has traded like this, but it's been like this inside of a range. And generally what has occurred is that the companies that had performed the best, kind of actually almost since '09, finally, you know, some of them that were just skyrocketing and never let up, finally gave back or corrected or started to digest some of that gain here in 2014, which is why, I think our 2 best companies, as we speak, according to our criteria and their position and everything else, is Cerner and Whole Foods. And those stocks, Whole Foods went from a low of $3.52 in 2009 to a high of $65.59 in 2013. And so we were aggressive buyers of Whole Foods in '09 and '10, but really the stock got kind of pricey even for us after that. We hadn't bought this stock since 2010 in a meaningful way. And actually, if you looked at your portfolios, we had shaved some back from time to time to repurchase other things that we wanted to buy and needed currency to buy them. And it was getting a little pricey. But that all changed this year. And so Whole Foods got as high as 65 and change. And we've been buying it as aggressively as we can recently at between 37 and 38. And we think it's a gift that, and these gifts occur periodically. You just don't know when they're going to occur. And this was really driven by, you know, a whole group of companies that had gotten very popular And we think in a number of cases for very good reason, particularly in this case. And then when the selling starts, it sort of takes on a life of its own. So we've been aggressively buying, recently we've been aggressively buying Whole Foods and Surter. And to do that, we needed to find places to find money to purchase them. And it came at the expense, in a large way, from Coca-Cola. We also had made in the fund, we had made an investment in, we bought some Microsoft and IBM at the end of last year, not because they were so tight to the criteria, but we had cash coming in, and I thought that they were quite cheap. And a good store of value rather than just holding cash. But when we have an opportunity, to buy our favorite companies at reasonable prices, those are the first things that go out. So Microsoft, which was bought actually at the end of last year at 31, we sold it at 40 recently to buy Whole Foods and Surter, and then we sold all the IBM at a slight profit to also buy the same two stocks. And culturally, Whole Foods fits about as tight as it gets. There's a book written by John Mackey, the CEO of Whole Foods. It's called Conscious Capitalism. I've got, I think, a couple copies of this if you're interested, but on page 30, it lays out our criteria about as tight as you can get. And I don't know if a lot of you might remember, we owned Starbucks for an awful long period of time, probably 15 years. Peter Lynch said that the United States is ubiquitous. So if something works in one part of the country, you can pretty count on the fact that it's going to work in other parts of the country. So unless, if the business is very successful and has the ability to build more stores, and they're not saturated, then the odds of success that they're going to be able to grow through addition of new stores is extremely high. And Starbucks had the advantage of having a highly addictive product. And we thought that was a real powerful business tool, and thought that it would probably be the only highly addictive brand that we would be able to get probably in my lifetime that doesn't hurt people. So Starbucks was an important holding for us for a long time. And although healthy foods is not quote unquote addictive, it's really hard to go back. And if you're a Whole Foods customer, it's really hard to change that lifestyle. And we do think there's a lot of power in the brand. And the stock did get very pricey. Like I said, we hadn't bought it since 2010, which is a long time. What initiated the stock drop here recently is that their same-store sales, which had been running consistently, other than 2008, consistently have run from about 7 to 8%, which is really remarkable. And particularly in the grocery food store area, it's a miracle, actually. If you look at the numbers of Safeway and the traditional players, they've really suffered over these years. And Whole Foods has been pegged with this idea of whole paycheck. And the power of the brand enables them to have that pricing power. But they didn't think that that was the model that they wanted to run on. And there's a lot of copycats coming into the market now that weren't there before. And God only knows we saw the same thing with Starbucks. They were emulated on every street corner. So it's not a surprise that this success would attract new competition. And so they proactively, have been lowering their prices in certain areas of the store. And it's driven their same-store sales from that 7 to 8% down to about 4 or 5%, and Wall Street had a total panic. And we are delighted that they did. We've been waiting 4 or 5 years to have this opportunity, and we were not, as Charlie Munger would say, we were not thumb-sucking on this one. If you look at your portfolios and look at what we, what number is that? 7. It went from a 2% position to a 7% position fairly quickly. And if you look down from there, Cerner is bumping right up against it at 6.5.
Russ?
Yes.
Okay, so price target on Whole Foods at $46.50 for the year.
You saw a price target?
Mm-hmm. Yeah, so that would be a pretty nice run up for the year, even in the last 6 months of the year, if they can get to that $46.50.
Yeah, I would venture to say that that same analyst might have put a $73 price tag on it when it was 65. If you look at analyst price targets, they're usually 20 to 30% above where the stock is. And then when it gets to that price, then they bump it up. We don't pay any attention to
Now,
that.
like you said, you've got some other players in the space, and one of them's Walmart bringing in.
No. Oh,
no, just because it's an environment doesn't mean that people won't gravitate to price. And that's one thing, with the model that you have, sure, the integrity's there. They're not the great Satan, but again, profit.
yeah, I mean, Folgers was not a competitor to Starbucks, and Walmart is not a competitor, in our belief, to Whole Foods. They're really two different models. And Walmart has their place and their space, but we really don't view that as good. There are literally copycat companies, the Fresh Market, and there's a lot of money available over the last couple of years for new companies to go public and raise a bunch of money and start building a bunch of stores. But if you look at their numbers, I mean, their comps are only 2 or 3%. And Starbucks had the same thing happen, and eventually the dominant brand will, we think they're the dominant brand. And what they're also becoming is the trusted authority. You could argue whether you believe that or not, but they're becoming a trusted authority on what healthy eating is. And that's a pretty enviable position, and they take it very seriously. Now, they could lose that trust at some point in time, but they understand these kinds of things. And they have a culture that breeds that, and that's why we think they're important.
And they do have a cash position that allows them to build out more retail positions.
They have their balance sheet is in a monster position. And actually, they're an EVA company, which is economic value added, which it's a discipline with how you allocate capital. Very few companies are good or certainly great or even good at how they allocate capital. EVA is a discipline which helps. We like that. There's a flaw with EVA, and that is that you need to the formula. Stewart and who is it? What is it? Stewart Nagy. There's a company there's a group that put this all together, and their philosophy was that you maximize every dollar on your balance sheet, and that's a flaw in their system. And Whole Foods bought into it before '09 and actually did not carry a lot of cash on their balance sheet and paid too much out in dividends to fit the EVA model as it was presented in its purest form. And they actually had to raise some capital in '09. And so the flaw in the EVA system, they understand it better than anybody else on the planet because they lived through the downside of it. And they have they've been building large amounts of cash over the last several years and piling it up, and are ready to spend it aggressively now on buying back stock and aggressively to expand their store base. What else we had?
So Whole Foods and Cerner are your most favorite stocks right now. Are those the ones, or if you had 5, which ones do you think are going to go up the most in the next year?
Oh, we have no idea. The only thing, we look for the criteria, and then we look for a reasonable entry point.
Okay.
And if we can get those 2 things accomplished, good things will happen over time. And I mean, Whole Foods has stayed down longer than I thought it would, and it really gave us the opportunity to buy a lot more than I thought we were going to be able to. You know, in many cases, they'll come down and spike right back up again. In this case, it didn't. Cerner pretty much did. I mean, it came down from 64 to 47, 48, and we had a few weeks to buy it, and then boom, it's right back up to 54. Whole Foods stayed down longer and gave us more of an opportunity to buy more than an adequate position now. And now that we have it all beefed up, I don't have to think about buying it again for another 4 or 5 years. And we can focus our energies elsewhere.
Must you like to keep just a certain amount? I mean, do you have a goal in your own hand that, okay, we're thinking this term to find out however many there are, 30? Would you welcome more?
Yeah, so...
Probably harder to manage.
Yeah, a couple answers to the question. A, we are not goal-oriented in any way, shape, or form. What's that question? Oh, I'm sorry. The question is there a goal? Is our goal to have basically 25 or so stocks in the portfolio or whatever we have in there now? The answer, our belief is, A, we don't have a goal for anything. In fact, Deming's idea was that you put 110% of your efforts on the process. And if you get the process right, the results will take care of themselves. And to have some vision in the future as to what you're going to look like we think, takes away opportunities.
So your MO is basically that you're sitting there at your desk, not just sitting there, but you're constantly thinking, these people are going to fit my criteria.
We're trying to buy as much as we can and the best companies we can. You know, we certainly need more than 15 companies, but beyond that, it's wherever it happens to fall. And this has been the model, though, over a long period of time. But we're not married to a particular number of anything in this. And the idea of not being results or goal-oriented, we think is really cool. Berkshire grew, he had no plan, he had no idea Berkshire would look like it is today. But he was completely willing to, seize every opportunity that he could see very clearly. And when those opportunities arose, you just take advantage of it, and suddenly things evolve. And I think it's more fun that way. Because you don't know what you're going to look like 5 years from now. The comment was, don't go crazy.
Yourself.
Yeah, I got it.
Russ, did you look at Epic at all? And if so, how does that compare to Cerner?
Yes. Well, Epic is a private company.
Okay.
They're not publicly traded. So we're very familiar with Epic. And so the question is, have we looked at Epic, which is Cerner's primary competitor? And what both companies do is they provide IT information services to the healthcare industry. When we started buying Cerner in 2003, there was literally hundreds of companies in this space. And the real big difference with Cerner was that everything they did was organic. All of their software that they developed, they didn't go out and buy pieces and put it together. They did everything internally, and the idea was, A, it creates a better culture, a culture of innovation inside the company. And B, when you, in the software business, when you need things to talk to each other, if you start buying and cobbling a bunch of things together, they don't do well together. And particularly at the early stages, if you do it all organically, it gives you a big advantage. And so as the years have gone on, this industry has gotten to be huge. And it was the last industry to adapt IT, computer basic technology. The healthcare industry was far behind because doctors didn't want to do it. And it's hard, it's really hard. Yeah, thank you, Dan. And it's really hard. I mean, healthcare providers here in the room will tell you that they hate this stuff because it's hard to implement, it's hard to get it right. And so as this industry has evolved, we've gone from hundreds of competitors to literally a duopoly. And that is Epic and Cerner. Cerner's claim is, and it's their claim, but their claim is that Epic has done a better job of making their software more comfortable, more user-friendly initially for the healthcare providers. And to do that, Cerner believes that they have created more of a closed system. And Cerner has traded off the fact that they understand that their software is probably more difficult initially to get people comfortable with, but to try to make it more open, they think that over time, when this industry explodes, and we think that it will, what basically you're doing is gathering data on the healthcare field, in the healthcare field. And this data is going to have enormous amounts of value for all of society over time. And to be able to plug in other software devices that take this data and do other things is really, I mean, our original cost basis on Cerner, going back to 2003, is probably close to $1 a share right now. And we think that this story is just getting started. As now that you have the platform to gather the data, then what do you do with it? And how do you most effectively utilize it? That's the beginning of the story, nowhere near the end. And Cerner, we think anyways, gets up every morning with that idea in mind. And they talk about the fact that this is hard. That it's hard to do, it's hard to, it's hard. And that we think that that's the barrier to entry. The pain that people like Daniel have had to go through, to work with this software, there's nobody going to come in on top now and recreate it. It was very painful to implement, as you, I'm sure, well know. And so we think that's a huge barrier to entry going forward. And we're excited about where this is going. And the problem has been, since, again, 2010, we saw all this happening, but the price was a little bit, even for us, was a little much that we could pay. And so we really never had the opportunity to aggressively, add to the position until this last year when we got this odd characteristic that all the companies that had done well decided to give a lot of it back. And so the stock went from 64, a lot of the stock we bought was in the 47, 48 range. And we're real happy with that. Spencer.
I don't want to get off the subject. Would you tell me briefly why you stayed away from Apple Computer?
The question is why have we stayed away from Apple Computer? Initially, we were actually, most companies, I mean, we're like, our criteria is really tight. And some companies will actually fit it that we can't tell if they fit it or not, and so we just move on. You know, Buffett talks about the advantage of the stock market is that it's like playing baseball, but you never get called out on strikes. So you can sit there with the bat on your day all day long, and they have to keep throwing pitches at you. And so, you know, you can let a lot of things actually go by that, you know, might be close or not, you know, that it's okay to wait for that perfect pitch where you can see it crystal clear. That said, there actually was a time when Apple's stock was really getting way ahead of it, well, was getting very, being priced aggressively, where we literally decided that there were some aspects about Apple that we wanted to avoid. And that is, if you think about all consumer electronic companies and devices, with no exception, none, no exception, eventually they get the margins beat out of them. They become commoditized. Even the most powerful brands in consumer electronics. Now, I mean, people don't care if it's a Sony or not right now. 15 years ago, would you have ever thought that that would have ever occurred? You know, we own the Rogers Corporation, which sells a little device to the Motorola, it sold a little device to the Motorola Razr phone, which went from a dead zero to 51 million units a year to the next year to a dead zero again. The problem with consumer electronic devices is you can re-engineer them very easily. And so over time, you know, brands become ubiquitous. It's very difficult to keep a strong brand franchise in consumer electronic devices. And Apple had it, and they were getting huge margin premiums. In fact, Verizon and AT&T were subsidizing their phones by like $400 a crack. That's, you know, that is unsustainable. And so there was a period of time where we really were actually proactively avoiding the story. You know, recently when the stock went from 700 to 300, you know, the price more than reflected, you know, the fact that it's not a, you know, a business. Fear keeps everything in check. It's when there's no fear that you have to be concerned. Think about the real estate market in 2006. No fear. People were borrowing subsidy money. They would never, ever considering borrowing under any other circumstances. And so what fear does is, John Templeton said that bull markets are born on pessimism, grow on skepticism, grow on, mature on optimism, and die on euphoria. And so basically what you have is everybody's locked in fear, and so any news that comes out at all that's concerning, people start thinking about 2009 again, and they get flushed out really easy. And so as they get flushed out, the ride's really bumpy. So for the best part of the move, the ride is super bumpy. And we like that. In fact, if you look, in '96, you can look backwards, and everyone said, oh my God, if I hadn't got scared out, I would have made a fortune just by hanging on and just relaxing. And then people's expectations go up, and the fear starts to go away. So in the early stages, you know, and a lot of people that come into my office now to want to put new money in, you know, they say, well, I'll only put as much money as I can lose it all. Those are pretty low expectations. We like that. And so, but you get to here, and people expect that they're going to make 15 to 20% a year. And then what happens, in our opinion, the volatility goes away. It's a straight up line. So we think as long as it's bumpy, it's healthy. We like all this bumpy, and it enables us to reposition the portfolio like we did this year to gain advantage. Now, go to 12. In spite of the fact that from 1974 to 2000, that the S&P went up 14.5% a year on average, There were 4 years during that period where the market went sideways or down. And they were 77, 81, 90, and 94. But we think what's very interesting is, after you get a flat to down year, then the numbers re-accelerate again. And so we think, so we're up 4%. The S&P's up 4% so far this year. That's almost even. A couple of down days and, we're down for the year or even. So we're actually hoping that 2014 turns out to be one of these flat to down years, and then we're going to have probably another run for a while. We're already halfway through. We've gotten this far. I don't know if it's the flat to down year, but I would not be disappointed. I would actually be joyful of the idea, and then we're kind of off and running again, and we won't get one for a few years. So the fact that this year has been trading in a narrow range, fits perfectly hand in glove into our thesis on from 2009 is similar to 74. Any other questions? All right, it's 8:45. Maybe I just want to just kind of wrap up. The big thing for us is having investors that are willing to come to these kind of events and understand the process, and in the process of doing so, have the ability to ride through some of these bumps. So we have the ability to compound your money in a meaningful way over time. And that's what we really appreciate, both the folks that are here and the folks that will be watching on the webcast. And so with that, we really appreciate you coming, and we'll just adjourn for the evening. Thank you.